Welcome to the first chapter of our Managerial Accounting course. Today, we will delve into the foundational concepts of managerial accounting and the significance of cost concepts in the business world. Let us begin our journey. Needs of management. Management requires accurate and timely financial information to make informed decisions. In the context of the United Arab Emirates, consider the rapid development of Dubai as a global business hub. Visionary leadership and effective management decisions based on comprehensive financial data drove the city's transformation. For instance, constructing the Burj Khalifa, the world's tallest building, required meticulous financial planning and managerial accounting insights. Purposes of cost classification. Cost classification is essential for budgeting, financial reporting, and decision-making. In the UAE, businesses ranging from oil companies to luxury hotels classify costs to determine profitability, set prices, and manage resources efficiently. For example, Emirates Airlines, one of the world's leading airlines, classifies its costs to determine the profitability of each route and to make decisions about fleet expansion. Learning Objective 1. Assigning costs to cost objects. Assigning costs to specific cost objects, such as products or departments, helps understand the cost structure and profitability. In the UAE's real estate sector, developers like Emaar Properties assign costs to individual projects, such as the Dubai Mall or the Dubai Fountain, to determine their financial viability and return on investment. Learning Objective 2. Classifications of manufacturing costs. Manufacturing costs are the costs incurred to produce a product. They are classified into three main categories: direct materials, direct labor, and manufacturing overhead. Let us delve deeper into each. Direct materials. Direct materials are raw materials that become an integral part of the product, and that can be conveniently traced directly to it. Consider the luxury car market in the UAE. Brands like Rolls-Royce or Bentley. The leather used in the car's interior or the metal used in the car's body are examples of direct materials. These materials are integral to the final product and can be traced back to specific vehicles. Direct labor. Direct labor costs are those that can be easily traced to individual product units. In the UAE's construction sector, the wages paid to workers who directly contribute to building a skyscraper, for example, Dubai Marina, are considered direct labor costs. These workers' efforts can be directly associated with the finished building. Manufacturing overhead. Manufacturing overhead includes all manufacturing costs, excluding direct materials and direct labor. This might consist of rent for the factory, salaries of factory supervisors, and utility costs. For instance, the costs associated with running the vast desalination plants in the UAE, which are not directly tied to clean water production, can be considered manufacturing overhead. Manufacturing overhead examples. Let us consider ADNOC, the state-owned oil company in the UAE. While the cost of extracting oil, direct labor, and the machinery, direct materials, are direct costs, the costs of maintaining their headquarters, the salaries of top executives, and research and development are examples of manufacturing overhead. Prime costs and conversion costs. Prime costs are the sum of direct materials and direct labor, while conversion costs are the sum of direct labor and manufacturing overhead. In the UAE's textile industry context, the cost of cotton, direct material, and the wages of the weaver, direct labor, would be prime costs. Meanwhile, the weaver's wages and the cost of running the weaving machinery, manufacturing overhead, would be the conversion costs. Classification of manufacturing costs. Manufacturing costs can be broadly categorized into product costs, direct materials, direct labor, and manufacturing overhead. The period costs include all other costs like selling and administrative expenses. For a company like Etisalat, a leading telecom operator in the UAE, setting up telecom towers might be a product cost. At the same time, their advertising expenses would be a period cost. Learning Objective 3. Cost Classification. Product costs. Product costs encompass all expenses related to acquiring or producing a product. Think of the iconic Palm Jumeirah in Dubai. The costs involved in its construction, from the raw materials like sand and stone to the labor that worked on it, all constitute product costs. Manufacturing product costs and transfer of product costs. These are the costs directly tied to the production process. For instance, Emirates Global Aluminium, one of the UAE's leading industrial companies, would include the cost of bauxite, energy, and labor in its manufacturing product costs. Once a product is completed, these costs are transferred to the finished goods inventory and eventually to the cost of goods sold when the product is sold. Cost classifications for preparing financial statements. When preparing financial statements, it is crucial to classify costs appropriately. Product costs. These include direct materials, direct labor, and manufacturing overhead. For example, the costs associated with producing luxury yachts by Gulfcraft, a renowned UAE yacht manufacturer, would be classified under product costs. Period costs. These encompass all selling and administrative expenses. The marketing campaigns of major UAE brands like Etihad Airways would fall under this category. Learning Objective 4. Cost classifications for predicting cost behavior. Cost behavior is fundamental in managerial accounting, helping businesses predict how costs change with varying activity levels. Cost behavior. Cost behavior examines how costs change as business activities fluctuate. Understanding cost behavior in the UAE's dynamic real estate market helps developers like Damic Properties anticipate costs as they ramp up construction projects. Variable costs. These costs change in direct proportion to changes in activity levels. Consider the fuel costs for Flydubai, a UAE-based airline. As the airline increases its flights, fuel costs rise proportionally. Fixed costs and types of fixed costs. Fixed costs remain unchanged regardless of activity levels. The rent for a storefront in Dubai Mall remains constant whether the store has 10 or 1,000 customers daily. However, there are different fixed costs, such as committed long-term, like rent, and discretionary short-term, like advertising. The linearity assumption, relevant range, and fixed costs. While we often assume costs behave linearly, it is crucial to understand the relevant range of activity where the cost assumptions are valid. For instance, a restaurant in Abu Dhabi might have fixed utility costs up to a certain capacity, but if it expands beyond that, it might incur additional costs. Comparison of cost classifications for predicting cost behavior. Understanding the differences between variable, fixed, and mixed costs is crucial for budgeting and forecasting. For a company like DU, a telecom provider in the UAE, monthly subscription fees might be fixed, data usage charges could be variable, and customer service costs might be mixed. Mixed costs. Mixed costs have both variable and fixed components. Consider the delivery operations of Talabat, a popular food delivery service in the UAE. While there's a fixed cost associated with maintaining the delivery infrastructure, the costs increase variably with each order processed. Learning Objective 5. Cost classifications for decision-making. Decisions and their importance. Every business, from the towering skyscrapers of Dubai to the bustling markets of Abu Dhabi, is a series of decisions. These decisions, big or small, determine the trajectory of a company. But how do businesses in the UAE, like the retail giant Majid Al Futtaim, decide whether to open a new mall, introduce a new brand, or expand into a new region? It boils down to understanding the costs that are relevant to that decision. Differential costs. Differential costs, sometimes known as incremental costs, represent the difference in cost between two alternatives. For instance, if Emirates Airlines decides between two flight routes, the differential cost would be the difference in operating costs between them. Similarly, differential revenue would be the difference in revenue between these two routes. Such costs and revenues are always pitted into decisions and can be fixed or variable. Opportunity cost. Every decision comes with a trade-off. Consider the UAE's decision to invest heavily in solar energy. By doing so, they forego the potential benefits of investing that money elsewhere, say in tourism or real estate. This foregone benefit is the opportunity cost. The potential gain from the best alternative option was not chosen. Some costs are past costs that cannot be recovered or changed. Imagine a UAE-based company that invested heavily in a new IT system. Even if a better system becomes available later, the money spent on the initial system is a sunk cost and should not influence future decisions. Learning Objective 6. The traditional and contribution formats. As we transition to our next topic, we will discuss the primary income statement formats used in managerial accounting. The traditional and contribution formats. Uses of the contribution format. The contribution format, often used in internal decision-making, separates variable and fixed costs. This format is handy for entities like the Dubai Metro. By understanding the variable costs, like energy costs per metro trip, and fixed costs, like station maintenance, the metro management can make informed decisions about fares, frequency, and expansion. That brings us to the end of Chapter 1. We have journeyed through the intricate world of cost classifications and their implications in decision-making, using real-world examples from the vibrant business landscape of the UAE. Stay tuned for our next chapter, where we will delve even deeper into the world of managerial accounting.